Real estate agents will face many questions from their home buyers. Among them will be concerns about terminology used within financial documents and titles. Agents need to understand the legalities of these documents so they can reassure clients they are making the right decisions for their future. One key and often misunderstood term is promissory notes. What are they? Why do they matter to you as an agent? What is a promissory note, and what role does it serve? A promissory note is a promise to pay. It's a financial document that states one party, called the insurer or maker, promises to pay another party, known as the payee. It lists the specific sum agreed upon. It also states when the debt will be paid, whether it will be paid in one lump sum or in payments with an end date. Promissory notes contain virtually all of the terms of a loan, and your client is agreeing to these terms when they sign their promissory note during the closing process on a home. These notes will include the principal amount, or the amount of money the home buyers agree to borrow to buy the home, the interest amount, the cost of borrowing the money to buy the home, the maturity date, the day on which the loan is due to be paid in full, the date and place of issuance, who, where, and when the loan is agreed upon by those involved, signatures of all parties. These notes are legally binding. Ensure your homebuyer understands that buying a home using a loan is a legal commitment without a simple way out. They also encourage them to buy a home that's within their budget, ensuring they are not at risk of overspending. During your initial meeting with your homebuyer, make this an important conversation. Ensure they've worked out the financials of their home loan with a lender, and be sure they understand the down payment requirements. All of this impacts the way you do your job. You'll need to guide the home buyer to purchasing a home that's within their budget, which is within the amount the lender has agreed to let them borrow. This ensures your time is spent helping a home buyer finding a home they can actually afford to purchase. A frank, open discussion is critical. There's much to discuss and explain to your clients. One important aspect is related to the security of these loans. Promissory notes are available as secured or unsecured loans. Secured loans. These are loans backed by collateral. For example, with home buying, collateral is generally the home itself. The loan is based on the value of the home, and the home protects the lender. Should the borrower default, the home becomes accessible to the lender to seize to repay what is owed. Most home loans are secured loans. Unsecured loans. These are just the opposite. The most common example is a credit card or a personal loan. It's given based on the personal credit history and financial security of an individual. These are very rarely used in home loans. Agents must explain to borrowers when asked that if they fail to make payment on their loan, they will lose the home because it is a secured loan. What is interest? Why do banks charge interest on a loan? While you may understand interest on a loan, it can be hard to explain. The short answer is that interest is the cost associated with borrowing money to buy a home. It's often expressed in a percentage. For example, borrowers may pay 7% to borrow the funds. Because home loans are secured loans, they tend to be a bit more affordable. Banks charge interest, of course, to make a profit in lending to a home buyer. It's important to instruct your home buyers to consider all of their options when borrowing, since just a small difference in a loan can make a big difference overall in what they end up paying for the home. Here's an example. When interest rates are low, the associated home loan payment the borrower pays is less. Let's say the borrower wants to purchase a home for $100,000. He or she secures a loan for 4% interest. They will make payments for 30 years. The monthly payment will be $477. And when he or she is done paying for the loan, they would have paid a total of $171,870 to buy their home. If the home is worth $100,000 and they pay 4.5%, their monthly mortgage payment rises to $507, and the total cost of the home increases to $182,407. That's why every percentage point matters. Usury laws. What are they? Banks charge interest to make a profit from borrowers. However, there are limits to how much they can charge. These limits fall under usury laws. This type of regulation governs the amount that can be charged on a loan. It's a law that's in place to reduce the risk that borrowers will pay excessively high rates to buy a home. The laws protect consumers. Each state sets their own usury laws. Discount points. Are they beneficial to your client? Your job as an agent may focus around helping your buyer find a home, but you also want to ensure they pay the smallest amount possible for that property. One way to help encourage them to pay less may be through discount points. Points are a type of prepaid interest. Paying 1 point means the borrower is paying 1% of the loan amount. It's often referred to as buying down the rate. Your home buyer may want to pay points to lower his or her interest rate on a home loan. Paying a 1 point means paying 1% of the mortgage amount. For example, 1 point is $1,000 on every $100,000 borrowed. By doing this, the borrower lowers the monthly payment he or she pays on the home. Here's another look. The buyer borrows $100,000 for a home and will pay it back over 30 years. He decides to pay 2 points. This means he'll pay $2,000 up front. On an interest rate of 4%, the monthly payment is $477. Without points, the borrower will pay $497 per month. Over 10 years, that's a saving of $2,000. Paying points like this can save the home buyer significantly, especially when this is spread out over larger loans. Overall, points will save the consumer per month on the loan terms. However, borrowers have to ensure that they have the money up front to make these payments. Understanding loan origination fees. Another financial aspect you may need to explain to your home buyers is loan origination fees. This is a fee that is charged by the lender on a home loan. View it as a fee to obtain a loan. It is paid to the lender as a fee to put the loan in place. Buyers will need to pay origination fees. This fee is usually between 0.05% and 1% of the amount of the home loan obtained to purchase the home. It pays for paperwork, calculations that are done to determine the loan rate and terms, verifications. In other words, it is a fee that pays for all of the research and setup of the home loan by the lender for the borrower. Again, If you purchase a home and borrow $100,000 to pay for it through a home loan, you will pay about $1,000 towards the cost of setting up the loan. It could be much lower. To find out what is anticipated as the loan origination fee, your home buyer can ask for a good faith estimate. This is an estimate given in good faith, meaning as accurately as possible, to the borrower by the lender. This estimate can help the home buyer to understand how much he or she will need to pay out of pocket to purchase a home. It is possible, in some cases, for this fee to be rolled into the loan as part of the closing costs. As a real estate agent, be sure to inform your home buyer of this and other closing costs as they begin the process of finding a home. For example, if your client is talking about having $10,000 to put down on the home sale and nothing more than that, explain that origination fees, among other types of costs, may also play a role in their out-of-pocket costs. As a result, this can impact the amount they can spend on a home. Knowing this in advance is beneficial to all involved. Prepayment clause and prepayment penalties before they sign. Your home buyer has plans to purchase a home and live in it for a few years before they sell it and move on. You're happy to help them find the home, but you want to make sure they are using the right loan for the task. This is the time when talking about prepayment clauses may become evident. A prepayment clause is a line in the contract they sign with their lender, within the promissory note, that states a penalty will be paid if the mortgage is paid off within a certain time frame. The penalty cost is usually a percentage of the amount borrowed, or a certain number of months' worth of interest payments. The home buyer needs to know if a prepayment clause is within the home loan contract. If it is present, when does it apply? This could be a number of years or months after securing the loan. And if present, the borrower needs to know how much that fee will be. Prepayment penalties help the lender ensure they will get enough compensation and profit from the loan if you pay it off early. Remember, if a home buyer buys another home and sells their existing one, they are paying that loan off early, and this clause may apply. Understanding straight loans. Straight loans are a type of loan. It is often referred to as a term loan or an interest-only loan. In this type of loan, there is a period of time in which only the interest on the loan is paid and the principal is paid at the end. Here's an example. The home buyer secures an interest-only loan, the most common term used by lenders today, to borrow $100,000. The interest rate on the loan is 4%. Each year, the home buyer will pay $4,000 towards the loan. If the term is for 10 years, at the end of those 10 years, the borrower will need to pay the original $100,000 in principal. This is known as a balloon payment. This type of loan structure seems affordable, but only if the borrower is confident he or she can do one of the following: pay off the principal in full at the end of the term, sell the home to repay the loan at the end of the term, secure a traditional home loan at the end of the term to pay off the $100,000. For those who are unlikely to remain in their home for a long time, this type of loan can be beneficial to them as long as there is no prepayment penalty involved. Amortization is a complex process that calculates the amount of interest on any home loan. In the above example, there is no amortization because the interest is applied. Most home loans are fully amortized. Some are partially amortized. In full amortization, the amount of interest paid by the borrower is spread out over the entire term of the loan. With every monthly payment, the home buyer pays a portion towards the principal and a portion for interest. Initially, more is paid towards the interest, but towards the end of the loan, the borrower is paying more towards principal, paying down the balance sooner. In partial amortization, the interest is paid during the loan term, and the principal is paid at the end, as described in the interest-only loan. The final payment at the end of a term is sometimes referred to as a balloon payment. Your homebuyer will receive a complete amortization schedule, which outlines how much is paid in interest and principal on the loan with each payment. This is given at the time of closing and is a part of the promissory note. Escalator Clause and Acceleration Clause. Within the promissory note, there can be terms for an escalator clause or acceleration clause. Here's how they work. Escalator Clause. This is a statement added to a promissory note that says the lender, or legal holder of the note, can decrease or increase the interest rate of the note with given notice. If it is present in a promissory note, the borrower must agree to it, as it can mean a higher mortgage payment. Specific conditions for this will be listed, such as cost of living increases. Acceleration Clause. This is a statement in a promissory note that may require that the loan be paid in full at a specific time beyond what the current contract states. Generally, it is due to a breach in contract. For example, if the home buyer fails to make 2 monthly payments in a row, this clause may go into effect and lead to a demand for payment in full. It may also occur if the home buyer doesn't maintain proper insurance on the home. A promissory note contains a wide range of individual components that lay out the terms for the loan. As a real estate agent, you may face questions about these terms from your prospective buyers. Having this knowledge shows your dedication and willingness to help them on their journey to securing a home. Please understand these concepts well enough to be able to guide your clients in taking the right decision. However, do not give any advice on what loans they should take out. Make sure you refer your clients to an actual mortgage professional early on in the purchase process, even prior to showing them any properties.